Hey everybody, hope all is well. We're continuing the series on annuities, and a question I get every once in a while is, what's new and upcoming in the annuity world? Because there's a lot transitioning and changing right now. So let me show you what's going on and why. The first thing is to recognize interest rates and what's going on with interest rates, right? So since 1982-ish, interest rates you could ski on, right? You could just go straight down the slope. We've had interest rates going down consistently in the United States for quite a long time. And I discuss that with clients sometimes, and you notice the little peaks and valleys. We try to raise interest rates and then we fall apart to new lows, and then we try to raise interest rates and we fall apart to new lows. Well, right now we're going through that rising of interest rates again until something breaks and they're going to come crashing back down. Where do they stop going up? That's hard to say. Look, inflation is more complicated than just a financial anomaly. But inflation is influenced by supply chain issues that we're having, whether it's because of shortages or less supply of gas, or things like manufacturing in China. We have lots of more complicated issues, and that creates this inflation. So when we see interest rates going down like this, bonds are a fantastic investment. But look at the bond industry on the top part of this chart. It's ridiculous at this point. 10 years, you've averaged a return of about 1% in bonds at this point. Bonds have been worthless for more than 10 years. You can look at 15, 20 years worth of results of bond portfolios, and they've been ridiculous and they've been worthless. And I've been screaming that from the highest towers I can scream it from. We shouldn't be in bonds. So we have to understand the basic principle. Interest rates rise, bond values go down, right? Well, hopefully you saw that in 2022. In order to combat inflation, the United States economists raise interest rates. We've always done that. Look at the 70s. The interest rates just kept going up and up and up. And that's why I'm saying we push until something breaks. Well, we don't know when inflation stops. We could fix some supply chain issues and things like that, but inflation could keep coming. So cause and effect. Your bond portfolios are going to lose you money during inflation. And who wants their safe investments losing money during inflation? Doesn't make any sense. You're compounding the problem. So certainly retirees shouldn't be in these bond portfolios. So we have to understand, we've got to get away from these bond portfolios until we go back to the 10, 15, 20% interest rates. If we ever go back to those, which I think it'll be awful hard to get back there with the amount of debt that we have. Right? So bonds don't make sense when we're floundering down here at the bottom of interest rates. So the past, the traditional management is stocks, bonds, mutual funds filled with stocks and bonds. That's all we've been doing for 30, 40 years. Every traditional portfolio was filled with the exact same thing. Every time I see a portfolio from another company out there, all the big names do the exact same thing for every single client, right? They've also trained all their employees for 20, 30 years that annuities and CDs and every other form of safe investment are far inferior to bonds. Well, as interest rates consistently go down and down and down, bonds have been the best safe investment. But over the last 15, 20 years, they've been worthless. And they've been hiding that information in the portfolio because the stock market has gone up, especially over the last 10 years. It hides the underperformers, okay? So the other problem we have is we've had commission only in the annuity world. So they tend to get sold more than advised just simply because of that. Salespeople gravitate towards those commission type products. And that is an issue in the industry. And it is why annuities get a bit of a stigma. It doesn't make them an inferior investment. It makes them sold sometimes. It makes people sell them under false pretenses. That does not mean it's bad. There are people on TV selling gold to you, fearing people into buying gold. That doesn't mean gold has a bad investable history. It's a good insurance against the devaluation of the US currency, which has only been getting stronger, by the way. So Where's the future going? Well, we've seen a lot of changes behind the scenes that you guys don't see. So the IRS provided a letter ruling in 2019 allowing these financial advisory firms to start taking management fees out of annuities without causing taxation to the client. That's a big difference there. That's going to allow them to put these in portfolios and continue to take a management fee out of there. That's good or bad, depending on how you're going to look at this. This is going to create more mass acceptance of the annuity world because they're going to be more commonly used. Okay. Fee-based annuities with no commissions are evolving. Right now, they're nowhere near as good or better for the client in any way, shape, or form, but they're getting there. Reducing that commission out should mean that they could pay the client more, making up for that management fee that's coming out. And we're not really seeing that yet. I've seen, the MIGA, the fixed annuity, the guaranteed like a CD annuity. If you're not sure what those are, I've made videos on those that'll be in this playlist. And so I've seen those where maybe you could get 5.5 with a management fee coming out or 5 with a commission. Well, if the management fee is 0.5%, it's the same thing to the client, but most people's management fees are more like a full percent. So these fee-based ones aren't making any sense. And as a fiduciary, you're supposed to do what's right for the client. And sometimes taking that commission is right for the client. So we have to be careful about just because it pays a commission, that doesn't mean it's automatically bad. It means that, we're now starting to see choices, but those choices with the fee-based side are worse for the client. We should not be doing that. Okay. So fee-based is developing. We're seeing better and better products on the fee-based side. Now, the other problem is that these types of investments are out with third parties, so they don't show up on your consolidated investment statement. So we're seeing more of the integration between companies and these consolidation companies that'll pull all of your accounts into one place and report values to you. We're starting to see that integration as well. And then we're starting to see a lot more innovation and growth in the annuity world because there's so much more demand. It's amazing how much money has been gravitating towards annuities looking for real safe investments. And as we have more financial planners recognizing that their clients are not going to have pensions in retirement, utilizing those income annuities properly, which has been the big problem. They're just getting sold to anybody, whether they need the income or not. Well, if you use those properly for the people that need more guaranteed income in retirement, they're powerful tools. So we're seeing this huge increase in use of annuities in the legitimate investing world because they do bring significant value. So this is what's kind of evolving in the industry right now. We haven't really needed this stuff in the past. Stocks and bonds have done just fine. Bonds, not so much, right? That's the problem. And everybody's starting to realize this. So now they're really starting to pay attention and evolve. So some of the new stuff we're seeing out there, RILAs. I think the industry has settled on RILA as the acronym. It's a registered indexed linked annuity. So here's the thing. If you don't know what a fixed indexed annuity is, watch the video on that first. All right. So because this looks like a fixed indexed annuity. Fixed indexed has no risk if the market falls. If the market goes down, you can't lose a penny. Okay. Whereas a RILA, a registered index linked annuity, the registered world means that it is risk-based. Okay. Now, the average consumer is not going to understand that, but that is what it means in our world. The registered means you need to have a securities license to do this. And so what you see here is these arrows. The green side is the profit side, and everything below that green side is the risk side. If the market goes up, they're going to give you caps mostly, we've seen in this. And a lot of people don't like caps, but these caps are 13, 14, 20% caps. They're pretty generous. So you have a lot of potential for gain in these. But The difference between the fixed side and these is you do take on the risk. So a lot of these use floors and buffers. Okay, so a floor says the most you can lose in this example is 10%. So if the market's down 30%, you're only going to get hit by 10%. Okay, whereas a buffer says the first 10% of a loss you don't have to take. So if it's down 5%, you don't lose a penny. If it's down 9%, you don't lose a penny. But if it's down 15%, you're going to lose 5. Okay, so a buffer gives you kind of that buffer on the down markets. So this is really an interesting way to look at how you can invest. You can still be heavily involved in the market and participate in the market with generous upside while managing your downside risk. This is a newer version of the variable annuity. Variable annuities, unfettered up and down, plus the average fee in variable annuities is 3%. Now, there's some low-cost ones out there, but they do really good job of hiding the fees, okay? Whereas these are going to traditionally have less fees than a variable annuity. And this is going to be the interesting part. I've modeled some of these, and the best fixed indexed annuities tend to do just as good, if not better, than the best RILAs I've seen out there, especially if we factor in a management fee, because these are really geared towards those traditional advisory management firms. Okay, so this is a new choice out there. Some of the bigger name companies out there are doing these. They are reliable, good investments. And just because they're new doesn't mean they're crazy. There's nothing wrong with these things. I think that they're evolving, though, and they do have to have the much higher earning potential. And we're seeing a lot better liquidity in here. Most of these are not going to have any penalties because they don't pay any commissions. So therefore, you can invest, for a year at a time type stuff. Okay. All right. So the next one that's interesting, and why I still think the fixed indexed annuity is superior to the RILA. One, because performance kind of proves it. You look through 20, 30 years worth of history on stock market indices and all that stuff, and the no risk with the earning potential we have out there in the fixed index world. Yeah, tends to do better than that RILA concept, but a little bit of a mix in portfolios is never a problem. So this one goes back to the fixed index world. So the regulators were questioned. Fixed indexed annuities are not allowed to have risk for the client. You cannot lose because of downturns in the market. And so the clarification came that it was principal that could not be risked. That's interesting because all the traditional fixed indexed annuities, you cannot lose principal nor earnings. If you earned, you can't lose those earnings. But the regulators clarified and said, no, it's just the original principal that you put in that can never be at risk. So because of options trading and the way options trading works, if you're willing to take on some of the downside risk, if the market goes down, they can give you more earning power. So the cool thing that somebody came up with, it was a bunch of actuaries and investment guys came together and said, we've got a really neat concept then. How about you can put some of your earnings at risk, giving you more potential earnings in the future? And so this concept began with a simple little chart like this. They said, look, you put your principal in, the example's $100,000. We can afford to pay you 105% of this stock index. And all they're going to do is put your money in 30-year bonds and then buy options on that stock index. So when it goes up, the market pays them because of those options, and they can just forward those on as profit to you, and they have no risk. It works really simply in the fixed indexed annuity world. But here's the thing, as you have earnings in there, your account gets to 102, 105, 111, 117. Once you go above 117, you have at least 15% earnings in there. You have room to lose up to 15%. Well, in that case, as you go down these tiers here, notice your earning tier. You go from 105% earnings to 130% earnings to 160%. So when it's up, you're multiplying the earnings and you're getting more and more, all the way to doubling the earnings. So if the market was up 10%, they had to pay you 20%. And it's because of the power of options trading. This is something so technical that the average person is never going to be able to do in their own portfolio. And even if you have an investment advisor, they don't have time to be managing this for all their clients. It's a nightmare to manage options trading like this, right? You have to have a building full of people to do this. Well, insurance companies do. So the power of this, holy cow, you can test it through 20, 30 years. This keeps up with the stock market, okay? The last 10 years, the market basically went straight up. 2020 or 2010 to 2020, the market went straight up. A fixed indexed annuity should never keep up with a market that only goes straight up. This one did. This one keep up. I did a 50-50, half the S&P 500 and half NASDAQ. NASDAQ, by the way, was the absolute, unequivocal, best performing index of the last decade, okay? So I did 50% S&P, 50% NASDAQ, and this beat it in that 10-year run-up. It was pretty impressive. So understand that you have the protection of the principal, but you can put your earnings at risk to achieve higher payouts, higher earning ability. And that's the cool thing. The other thing is they pair this with what's called low volatility indices. The low volatility indices look for volatility, VIX index, and they rotate into things like cash and treasuries. And yes, some of them rotate into short-term bonds. So 2022, those low volatility indices did not do well, just as nothing did well, and you did lose. But my example there of 2018, that index was down 1.6%. Well, yeah, you lost 1.6%, but you still were earning 200% when it went up 11% the next year. That's the power of this. That's fantastic. You can never put your principal at risk. You have to have the earnings already in there from previous years in order to obtain the higher earning tiers. Pretty cool concept. You want to protect your principal and still have the earning power of the market. This really does it. It's pretty cool. So somebody who has a really conservative portfolio, the problem is when we have those 10-year runs, they're going to fall behind, right? Well, this will help them keep up. That's a great way to utilize this type of fixed indexed annuity, adding it to somebody who already has a lot of these and just got tired of the market and doesn't need all that market volatility. This will help out. All right, hopefully that helped. There's a lot of fun stuff coming out in the annuity world. The income annuities are developing as well. I think one of the powers of the RILA is the add-on of the income annuity side. So people in their 40s and 50s should start considering that if they're not going to have a pension in retirement and they're only going to have Social Security. I'm not worried about Social Security going away. I certainly do think that we may see it continue to shift out further and further. People tend to be working longer. It's weird. We're seeing yin and yang in the retirees. I'm seeing people retire in their 50s and then, you know, people working all the way to their 70s. And so they're looking at possibly pushing out Social Security. That I can see happening. I don't have any faith or any problem believing that Social Security will be there in the future. We have to meet our obligations, otherwise our currency will plummet. So wouldn't worry about that. Lots of fun stuff in the annuity world. When used properly, they're very powerful, wonderful investments. But that's what I always tell people is they have to be used properly. Have an advisor put a plan in writing and saying, here's why I'm using annuities, here's where I'm using them, here's what they're going to do for you. If you get that, then I have confidence that they're actually being used properly. If they just came with a dinner seminar, they're typically just selling it to anybody that will take it. So be careful. All right. If we can help in any way, let us know. This whole month, I'm doing annuity classes all across the valley and on the web through Zoom. If you don't know about our classes, go to our nonprofit organization, fpfeaz.org. fpfeaz.org is the nonprofit website. And that's how we do all of our full class education in person and over Zoom, public education all over the place. So shoot us an email, give us a call if we can help out in any way. If you haven't subscribed, please, we got to add to the subscriber list and keep that building. Share it with friends, like the video if you like this, and comment below. Are there any annuities you want me to talk about? Is there anything in the annuity world you want me to talk about? Go ahead and comment below. We keep an eye on those and try to interact with all the comments out there. Thanks for joining us. We'll see you next week.